Good morning, good afternoon, and good evening, everyone. And thank you very much for joining the PwC UK GCC Quarterly Tax Dialogue Series. We're excited to have you connecting with us today to have a conversation on taxing multinational enterprises through effective transfer pricing. As usual, on this dialogue series, we ensure that taxpayers and governments are adequately represented so that we can discuss the issues from various perspectives. Joining me on this dialogue series today is the head of transfer pricing at the Ghana Revenue Authority, Mr. Moses Yidana. Moses is a member of the Institute of Chartered Accountants Ghana and also a member of the Chartered Institute of Taxation Ghana. The interesting thing, or one of the things that I find quite interesting about Moses, is that he brings to this panel both a private sector and a public sector perspective to our conversation, having worked with one of the big four consulting firms and now heading the transfer pricing units at the Ghana Revenue Authority. Moses, can you please confirm that you can hear me?
Yes, thank you for the brief introduction. Yes, I can hear you right. And good morning.
All right. Good morning, Moses. Good morning. Next panel member that I would like to introduce is Kingsley Owusu-Ewli. Kingsley is a tax partner and he heads the transfer pricing unit at PwC. Just like Moses, Kingsley is also a member, or to be specific, a fellow of the Institute of Chartered Accountants Ghana, a member of the Chartered Institute of Taxation Ghana, and also a barrister and solicitor of the Supreme Court of Ghana. We're excited to have Kingsley join us, considering his vast experience, both from working in South Africa and also consulting for various countries, right from Ghana to Sierra Leone to Liberia and to the Gambia. Kingsley, we're excited you had the time to join us today. Can you please confirm you can also hear us?
Yes, Abeko, I can hear you. Thank you very much. Good morning.
Good morning. So as we usually do on this series, we'll start by ensuring that as your moderator, I get you all to the same page. And the whole idea is to confine our conversation to the topic. So to guide our conversation over the next 2 hours, we have set out this agenda. One, as your moderator, I will give you a background to our conversation on transfer pricing. I would then open up for us to have an extensive panel discussion. And then lastly, you will have the opportunity to send me questions which may not have been covered in the presentation or from the panel discussion. And then we can have an insightful conversation. To begin, we appreciate the fact that companies typically would have a motive to earn profits. Tax authorities, government would also want a bit of that profit. So if you look on the slide showing, there's a green text, which we call tax. So while the company is looking at making profits, government is also looking at getting some tax. Our focus today on transfer pricing, unless we have time to go beyond, will be to concentrate on how transfer pricing affects the tax, specifically the income tax that is paid by companies. So ordinarily, and if we take the case of Ghana, our tax is a percentage of the profit before tax that a person earns. Or to be specific, it is a tax on the profit before tax that a company earns. So the more the profit a company earns, the more taxes or income taxes that is expected to be paid to the states. So a little bit of an example so that you can follow the conversation and confine our discussion is, let's assume that a company makes a revenue of 120,000 Ghana cedis. Let's assume that that company has cost of sales of 90,000. So a profit of 30,000 is made. General and admin expenses are incurred. The company incurs capital expenditure and hence should be given some relief for the expenses that are incurred. The company's operations ought to be financed. So we've assumed a certain amount. So we can see that for this particular company, although we started with a revenue of 120,000, we've ended up with a profit before tax of 16,000. Let's assume that a general tax of 25% applies. So tax of 4,000, or to be precise, income tax of 4,000 is paid by this particular company. To guide our conversation, let us also assume that this company does not deal with any party that it considers related. Let's assume that this company is a standalone company and hence does not engage with a related party or related parties. This is a very simplified way businesses work. In our modern society, businesses do not work this way. So if you pick the phone that you use, maybe an iPhone, a Samsung, a Nokia phone, and you research a bit on how the phone came into your hands, you would realize that that company and the phone that it has produced for you may be a mix of various parts of a group interacting. So the company could have been set up by the group headquarters. For the purpose of our conversation here, we can see the company as distribution company B. So the company, for instance, is set up in the US. Assembling of your phone may not take place in the US. It may take place in China. The Chinese entity would be producing those phones using the intellectual property coming out of the US. For efficiency purposes, you may set up a group entity that does procurement, that provides administrative support, and does so many things, even outsource employees. So you could see that company as, for instance, what we see here, the group services company. Going back to the phone example, the group production company may have produced the phones and delivered them to distribution company A, which may have excess phones that it sells to distribution company B that it onward sells to you. The question is, if you have this situation, can we say that if this company was indeed engaging with third parties, the tax to be paid to the government of Ghana is 4,000? So let's give an example. Let's now assume that a Ghanaian company deals with another company. For instance, the Ghanaian company, distribution company A, deals with, say, the distribution company B. Now, when it sells to distribution company B, it did not make the 120,000 that it would have made when dealing exclusively with third parties. Now, let's assume that it rather made 110. Let's also assume that its cost of sales have gone up because it purchased from the group production company. So instead of, say, 90,000, it incurred 95,000 cedis. So what you can see is that in the case where there was no related party, The gross profit was 30,000. Now it is 15,000. You can see that in the case of no related party, the tax was 4,000, whilst in the case a related party is involved, the tax is 250. Is this really the concern of government or to government? Let's also take one more example. Ghana may actually be a country with a lower tax rate than another country. So going back, if we assume Ghana is distribution company A, and a tax rate of say 25% applies, and distribution company B is in say Mozambique, and let's assume that a tax rate of 35% applies, then you may see that there will be an incentive possibly to sell or to earn revenues of 130 and to have cost of sales from the production company of 85. At the end of the day, you can see that the tax paid here is 7,750. These are the sort of things that we would be discussing today. And before we get into our panel conversation, certain questions may be asked by the tax authorities. One, is the group headquarters finance being provided to distribution company A, B, and even the group production company? What would have been charged if a third party was being engaged? Is there really an incentive to even charge interests, assuming that this distribution company A and distribution company B were new companies? So enough about financing. We'll explore that a little bit. So focus on the line interests to address the issue on financing. Shifting our attention to the administrative services, and maybe on the slide, you can focus on general and admin expenses. Is the cost that is being charged by the group services company fair? Is it what would have been charged if a third party was being engaged? Is that service even necessary? Those are some of the questions our panel members would be engaging with us as we go into this discussion. Lastly, some of the things I want us to remember as we go into this conversation is that some people tend to see transfer pricing as something necessarily wrong. What we wish to say before we even go into the conversation is that transfer pricing may not be wrong, even though it's a procedure that government uses to protect its tax base, or some would even say its tax revenues. The reason is that transfer pricing may not be applied because you actually set out to avoid taxes. So going back to the example I illustrated at the start, you may have an instance where the company is actually a new company. You want to help the company get on its toes. Should you now start inundating the company with high interest as a group company? Is it the reasonable thing to do to give the company probably interest-free loans? And when the company does well, you earn dividends? These are some of the questions I would want us to engage our minds with. Transfer pricing is not only or the only anti-avoidance measure that one may have in various tax laws. So in Ghana, we have similar provisions or provisions that are aimed to protect the tax base. Some include income splitting. Some even include thin capitalization. And questions that hopefully our panel members will help us address is the thin capitalization provisions in our law still relevant in the light of the development that we've had in the transfer pricing space? Is it about time we ask ourselves, what does that ratio really mean? Yes, some may argue that it is used to determine an appropriate capital structure while transfer pricing is used to determine the tax rates, or the interest rate that should apply. But I tend to move to another school of thought that says that the bottom line is that transfer pricing should address these issues so that a company is not subjected to strict thin capitalization provisions and at the same time subjected to transfer pricing. Transfer pricing, income splitting, thin capitalization, others, which I'm saying that I tend to agree with the school of thought that it is not arising because one wants to necessarily avoid tax. It means that there are certain things that would apply when one sets out with a motive to avoid tax. And in Ghana, what one tends to have is we have general anti-avoidance provisions and what others may also call tax avoidance arrangements. In some jurisdictions, they may not talk about general, they may talk about specific, they may talk about targeted. And in that respect, some may even move transfer pricing, income splitting, and thin cap into those conversations. So audience, this is the background that as your moderator, I have decided to set out. And then we can engage our panel members for a very insightful conversation. So to start, I would ask Moses, who heads the transfer pricing unit at the Large Taxpayers Office, to give us initial comments following this brief presentation to get our audience on the same page. And then subsequently, Kingsley would also share a couple of insights. Then we can start with specific questions to engage our minds. Thank you very much. Moses, over to you.
Thank you, Abeku, and good morning again to our audience. Yeah, so my initial comments will be that just as you have rightly depicted sitting in front of us, generally, as you have said, pricing of goods, services, financial arrangements between persons who are connected, or what we describe as control persons. Obviously, there's nothing wrong with that. But for some of the support that our taxpayers are getting from their parents and associates all over the world, a lot of the things that our taxpayers are doing in Ghana wouldn't be possible. So obviously, pricing of goods and services among these related parties, as we call it, there's nothing wrong with it. The bigger challenge has to do with when the line is crossed in the perspective of mispricing. And generally, somebody will say is that the rational taxpayer will want to pay either no tax or less tax. And in an attempt to do that, the government is deprived of its fair share, such that profit or taxable income is moved to jurisdictions that favors the group. So that is where the concern begins to come up. And therefore, the transfer pricing regulations, which is global in nature, we'll be talking specifically on our transfer pricing regime in Ghana. And basically, the objective is to minimize mispricing of goods. Once a multinational is engaged in dealings with this related, we from the Ghana Revenue Authority, we ordinarily would not have any issues with that because it is part of business, and we can only urge their business to strive so that we can also collect taxes that is due Ghana. So that's my initial comments, Abeku.
Thank you very much, Moses. You are here to support businesses to thrive, and that is quite comforting. Kingsley, what are your initial comments?
Thank you, Abeku and Moses, for starting well ahead of me. I think you've generally covered the grounds, but I have a few points to make. The first really is that transfer pricing is not a tax. So nobody should see transfer pricing as a separate tax line or handle on its own, right? Transfer pricing exists to ensure that there is fair an equitable, if you like, attribution of income to the country or the jurisdiction or the location where the economic activities are taking place. Every country has a territorial sovereignty and has a taxing right over that territory. So whatever economic activities are taking place in Ghana, the government of Ghana, okay, led by GRA, has the right to tax those economic activities. Now, when businesses are set up and begin to operate, we know that generally speaking, they have a profit motive. And if businesses or artificial persons have profit motive, as you depicted here, I mean, in the case of, in case A, case B, and case C, you see that they are making profit. Generally, they have profit motive. So with profit motive comes that expectation that whoever I'm selling my goods to, my customers and my suppliers, must sell and price their goods as would generally pertain between independent parties, okay? And if the pricing or the arrangement does not accord with what would generally prevail between independent parties, there's that tendency that someone or a business which has been set up, okay, to actually achieve profit may end up incurring a loss or may earn more profit than it should. And you know, with globalization, companies or multinational enterprises trade across countries. Each country has different tax rates. I think you gave an example of Mozambique compared to Ghana. So with these differences in tax rates, with the differences in the tax laws, there is that incentive, you know, or motivation to sometimes price arrangements in a way that may distort the true economic, if like, activities or contributions of one state or one country versus the other. Hence the introduction of transfer pricing as a measure or a means to ensuring that whatever, you know, trading, dealings happening between persons who are in control relationship, right, are done as at a price or using terms that will ordinarily prevail between independent parties. So, I mean, for me, the starting point is that transfer pricing is not a tax. It is just a means to make sure that we allocate the right expenses, right income to the businesses and the countries which are actually contributing and generating it, and there's no distortion. And where there is, all that transfer pricing is seeking to do is to restate the price or the terms, okay, to those that will prevail between persons who have no relationship whatsoever. I know we'll get into that. And then finally, transfer pricing covers, you know, transfer of property, transfer of services or provision of services and goods. So thank you, Abeku, for now.
No, thank you very much, Kingsley.
I know there are more questions coming.
Yes, there are several. We have a lot of questions, and maybe I will start with you, Kingsley. When giving us your preliminary comments, just like Moses, you kept talking about controlled relationships. What does that term really mean? How different is it from those that choose to use the term associates? How does that also differ from persons that uses the term related parties? Are these terms all the same? We needed to get our audience on the same page. So controlled relationship, related parties, associate, what does this term mean? You could probably pick one or two of this, and then Moses can also help us with what these terms really mean. Thanks.
So, yeah, thank you very much, Abeku. As far as the law that set up transfer pricing is concerned, this essentially, it says that when persons are engaged with other persons who are in control relationship with that person or those persons, the transaction has to reflect arm's length. So you are right in asking then, if transfer pricing is all about transactions or arrangement between persons who are in control relationship, then what really constitutes, this control relationship? Control relationship has been defined in our local law as that relationship that exists between a person and any other person, okay? One, who is an individual and a relative of that individual. So all of us individuals who have joined the call today, if we are engaged in a transaction, okay, with another person who is a relative of us, that transaction, the law is that transaction must be done at an arm's length. It should happen at a price that will prevail between persons who are not relatives. So if I'm selling my a glass of water, or let's say a 330 ml Belacqua, to my sister, for instance, I should be selling it at the price that, for instance, the company making Belacqua will sell it to any customer or anybody who is interested in drinking. So individuals and relatives of those individuals, and relatives have been defined to include children of that individual, grandchildren of that individual, parents and grandparents of that individual, first cousins, not second, not third cousins. So your second and third cousins are excluded, okay, from the definition. But first cousins are included. Your niece, your nephew, your aunt and uncle are relatives of your individual. Of any person or any natural person. So that's point one. That's the first bucket of what control relationship actually means. Then the second bucket is really, it concerns artificial person in the form of a partnership. When you set up a partnership and it is registered, anybody who is a partner there, okay, or in that partnership, partners are seen as persons in control relationship. At law, every partner, can actually jointly and severally and join or commit another partner. So they can take decisions for and on behalf of other partners. And so when partners begin to deal with themselves or among themselves, that can constitute, a control relationship. That is in fact a control relationship under our law. Then you have a third bucket or basket, which is an entity. An entity, okay, which is controlled directly or indirectly, obviously by way of membership interest or voting power. The law there used to be 50%. So up until the beginning of this year, April, the law in our Income Tax Act was a voting power of 50%, directly, indirectly. But the law has since changed, and I'm sure Moses was very instrumental in making sure that that provision actually changed. And finally, there is also, if you like, a subjective test, not an objective test, a subjective test in the sense that in the absence of you holding a voting power or membership interest in an entity, constituting the 50% or currently 25%, right? If you begin to deal with your stores, even in the absence of the 50 or 25, in a way that one entity, an entity A, is actually sending instructions, sending requests, okay, in a way that constitutes control, that the law will regard it as a control relationship. because if you look at the transfer pricing regulation, it says that the TP regulation actually applied to one, not only arrangements between persons who are in fact in control relationship, but it also covers arrangements that are deemed or regarded as constituting. So a subjective test to determine whether in the absence of voting power, in the absence of shareholding, there is some control or influence, significant influence, affecting the arrangement or the pricing. So I'll pause here to see if Moses has any reaction or an addition to make to it. And then if I need to come back again, I'll come back then.
Right, so thank you very much, Kingsley. So yes, Moses, please come in and then deal with the second part of my question. That is, how different is this term associate from related party transactions as accountants would generally use? Over to you, Moses.
Thank you, Abiku, and thank you, Kingsley. Yeah, I think Kingsley has done a good job to what generally in Ghana we term as control relationship. I know in other jurisdictions it's been referred to different terms such as connected persons, associates, and different forms. So in Ghana, basically, Kingsley has given us the 3 or 4 instances where control relationship may be created or exist. I think just to add to 2 of the very important signposts, i.e. in the case of where it is an entity, where an entity and another entity may create control relationship, apart from the interest in the form of capital, where one entity directly or indirectly is participating in management of the other entity or in directing the affairs of the other entity, that could create a control relationship between 2 entities. So that is just an addition to the capital of 25% or more. Then I think he described it as a subjective test. Obviously, yes, you can describe it as subjectivity, but generally it depends on the conduct of the parties. Even though you are not directly participating in a form of capital or in management or control, but as he said, based on the conduct of parties, one is influencing the behavior of the other, and we have evidence to that. Obviously, a control relationship could be created. And maybe the last one, which Kingsley didn't mention, though we don't have it too much, a trusteeship relationship that obviously between the 3 parties will obviously create a control relationship. So just to add to that. But obviously, I think what is more important, other than the capital participation of 25%, is mostly driven by the conduct of parties. Yeah. And then to deal with the last part of your question, is there any relationship between control relationship, related parties? They could be, even though they are from different nomenclature. For example, if you say related party, to my mind, related party is an accounting term, specifically IS 24 provides for related party disclosures and the like. So related party is an accounting term, but so far as tax in Ghana is concerned, or transfer pricing, we describe it as control relationship. And the 5 indicators that has been given under which a control relationship may be created and may not exist in certain related party relationship. So you may have a related party relationship that exists between 2 entities, but that may not create a control relationship. So Abiku, related party, it is an accounting term, and so far as the tax law is concerned, there may be instances where there exists a related party relationship in accounting, but for tax purposes, it may not exist, and the vice versa. So basically, that is what then the issue of associates. If you look at our definition of control relationship, associates forms part of a control relationship. So control relationship is much broader than an associate. So associate is just a subset of control relationship. So that is what I can say.
So Moses, maybe I'll come back to you. So even though our topic is concerning multinational enterprises, let me probably start from home and then get international. So let's assume that I have a conglomerate. I am into sugar business. I have a media company. I have a company that sells building materials. As a Ghanaian, should I really get concerned about transfer pricing, or under our laws, transfer pricing is only for foreign businesses that seek to invest in Ghana? Moses.
Thank you, Abeku. Yes, so so far as our transfer pricing regulation is concerned, the rules of transfer pricing is applicable to both cross-border transactions and domestic transactions. So if you have a Ghanaian company and you have different entities or different, in different businesses, once they begin to deal with each other, the requirement of the law is that such transactions ought to comply with the arm's length principle. Basically, the pricing should be fair, or what we can say, it should be market price. So either you are dealing domestically or the transaction is cross-border, our law is requiring that you are dealing with a related party, the pricing should be as if you were supplying the goods or services to a third party, and the pricing should be fair and in accord with the arm's length principle, which, I mean, it's an international concept. So, Abeku, the straight answer is that transfer pricing rules is applicable to domestic transactions.
All right, so thank you very much, Moses. So if tomorrow I decide to set up a chain of businesses as a Ghanaian and none of my businesses goes abroad, I should still be concerned about transfer pricing. Moses, you talked about arm's length pricing, and Kingsley talked about adjustments. We obviously need to make sure we understand these terms. So as we can see from the slide, a little modification ended up with a tax payment of 7,000, and in another case, 250. So getting into the methods, Kingsley, what does arm's length pricing, arm's length standard really mean? One, and then two, what methods are really acceptable to the GRA? How would you go about picking my 110,000 and then adjusting it to 120, or picking the 95,000 and adjusting it to 90,000? What methods do you use? So in brief, what does those standards really mean? And maybe you can extend it to confirm whether that is the only standard. And then as taxpayers, how do we get enough guidance? Which guidance, in your experience, Kingsley, are acceptable to the revenue? Is it, I keep hearing things called OECD, UN? What are all these, and what should the audience really understand from this session?
Thank you, Abeku. So at the heart of transfer pricing is what we call the arm's length standard. You can consider it as the heart and the eyes of the human being or mankind. Without arm's length standard, transfer pricing will not work. It is an objective criteria or standard that is really used as a guiding post in getting to that price which is believed to be the right one for every unique transaction or arrangement. In some, it is said that a transaction or an arrangement, right, between persons in control relationship accords or is consistent with an arm's length standard if it is the same or similar to the price or an arrangement that will take place between persons who are not related or persons who are independent of each other. Okay, so arm's length standard is really the price or an arrangement that exists between persons who are not related or they are independent. And when businesses begin to deal with persons who are in control relationship, associates, or related parties, I mean, using these terms loosely, the price has to be or must reflect those that exist between independent parties. Once you achieve it, okay, Moses and the Revenue Authority will not have an issue with you unless, I mean, there are other residual reasons why they could have, but ordinarily, if it's all about the price, everything else is okay, and it's all about the price. Once you can demonstrate that this price I'm paying actually pertains out there between independent persons or parties, the revenue should not have an issue. Now, I think the second leg of your question is, how do you arrive at that price? You arrive at that price by using certain methods or certain means or approaches which have been generally, let me say, globally accepted. And fortunately for us, all our transfer pricing regulations we've had since 2012, generally speaking, accepts these methods. One is the comparable. One is CAP, and CAP is comparable and control price method. That is the most direct method of arriving at the arm's length price. Essentially, under that method, you are comparing a transaction that is happening between persons that are in control relationships. So we call it a control transaction, to another that is happening between persons who are not in control relationship. In some circumstance or situation, the CAP method or the CAP method can also actually look at pricing from one entity's point of view, okay, but then looking at it from a two angle. Same entity providing services to a related party or a person in control relationship, as the law puts it, and in other breath, providing that same service or supplying that goods to another person who is not related or in control relationship. The price you sell to that person who is independent of you, the seller or the producer, the manufacturer, generally will be deemed and accepted as the arm's length price. So that your price that you are selling or transferring the goods, property, to that person who is related must reflect the price you sold to that independent person. So that's really one of the methods that is used. If you find yourself in a situation where you are engaged in supply of property, services, and you are selling to both, customers who are not related and customers who are related, then you should be using the customers who are not related as a benchmark of some sort in selling to those who are related. But more often than not, we know that business is complex and you may not at all times be in such situations. So there are other methods. One other method, for instance, is the resale price method. So I'm in Ghana. I deal in goods that have been already manufactured. So finished goods, I import finished goods, but only from my related party or someone who is related to me. And then I on sell, the goods to another person or to persons who are not related. If you are in such situations, you can use this method, which is called resale price method, to actually determine whether the amount you are being charged, actually makes sense. So distributors will generally use it. Another method is actually what we call cost plus. So cost plus method actually works best, or this is how it is. There are instances where businesses will be providing services, okay, to related parties or persons in control relationship. The services they provide, there is a cost that they incur. What is the sum of the cost? And in that industry, in that sector, what profit is, let me say, fair, reasonable, or expected, okay, within that industry? So you build up your cost for making a product for a related party, the cost for delivering a service to a related party, and then the plus. So it's cost plus. The plus becomes the profit, which is reasonable, which is comparable to those profit or margin, but it's markup, that companies or entities in that sector make. Then there is also another method, transactional net margin method. Transactional net margin method works best, by looking at relevant financial indicator. In this case, ordinarily, you are looking at the operating margin of the entity. So you have, let's say, distribution companies selling alcoholic beverages for and on behalf of their principals, and such distributorship generally will make a certain net profit in that sector. But because I'm dealing with a related party, the related party out there can decide to overcharge, in quotes, can decide to overcharge me, leading to significant, if you like, a reduction in the expected level of operating margin or net profit levels in country. So when you are in situations where the transactional net margin can work, what you are basically looking at is a delivery or a return on your profitability, which is comparable to persons who are engaged in similar, businesses. And apart from these methods, there's also the profit split method. Okay, and there's also a profit split. But basically, the name gives it out. It's splitting. Under the regulation also, there is an unnamed transfer pricing method. If you are engaged in transaction with a control person and none of the methods I've mentioned, whether it is the cap, it is the resale price method, whether it is transactional net margin method, whether it is cost plus, if none of these actually works, you need to write to the Commissioner General. I'm sure you will go to Moses' desk and they would look at it. You write to them indicating that the methods that have been given in the law for one reason or the other is not giving me the right price. And I intend to use another method to arrive at the price which is comparable to what persons who are not connected, are engaging. Such method will be reviewed by the Revenue Authority and then approved. All these methods I've talked about are actually coming from methods or from international conventions that have been existing since the early 90s. One, I think, Abeku, you talked about it. It is the OECD. The OECD is a group of developed economies or countries, and they've realized long time ago, because they were dealing among themselves, that, look, trading within a group can potentially distort profits or can shift profits away from jurisdictions that should be having the right to tax it. And so they developed this best-in-class, globally accepted, convention on transfer pricing. It serves as a guide on what the arm's length standard is, transactions which should be impacted by the convention, the documentation, if you like, conventions around it, the power of the revenue authority to pass or make adjustments, etc. But as I said, it's the OECD TP convention. It's a convention that came from the developed economies. So the United Nations, which is an international organization for the entire world, including developing countries, also developed a convention, which is also best practice, but more suited for developing economies or countries like Ghana. So we have two globally acclaimed or accepted, if you like, guidance when it comes to ensuring compliance with the provisions around transfer pricing. Thank you, Abeku.
Thank you very much, Kingsley. So just to summarize for the sake of our audience, in response to my question on what or how can I readjust the 110 to maybe 120 or 130 to 120, you have indicated that there are 5 primary methods, if I choose to call it that way, which may not require an approval from the GRA. But if your transactions are such that none of those 5 works, then I can make an application to use another method. And then you've also mentioned that generally there are 2 authoritative guidelines, which is prescribed by the OECD or by the UN. So maybe I would go to Moses to find out, Moses, does the GRA really have a preference when it comes to the source of documents one needs to rely on for the purpose of transfer pricing? So if the UN guidance provides something which is at variance with the OECD, what is the usual posture of the revenue? 1. And 2, as you may be very much aware, we've had transfer pricing provisions, as far as I know, since 2000 in a repealed income tax law, which others may precisely call the repealed Internal Revenue Act. But it wasn't until 2012, 2013 that we really started to, as some may say, chew transfer pricing properly. This puts us, on quote, at a disadvantage whereby we don't have enough information. So Moses, apart from answering the question on whether the revenue has a preference on the source, how do we even know whether an entity is comparable or not? So let me give an example. I produce water in my conglomerate. Should I be looking at Voltic? Should I be looking at Belacqua? Should I be looking at Awake to be getting data? And even if I don't get data from them, am I permitted to go outside the shores of this country to look for comparable data? So Moses, those are the questions that I have for you. 1 on the source, 2 on data source, and then 3 whether the revenue really has a preference in the event that there's a conflict between the OECD and the UN, for instance.
Thank you, Abeku. Yeah, so in terms of the method that Kingsley has just briefly described to us, yeah, the selection of methods generally depends on which of them is more suitable to the transaction and gives you a very fair and the reflective of the transaction, the economic nature of the transaction. And when it comes to the selection of which of the guidelines to use, and as they are just guidelines. So the starting point is that, does our domestic law make specific provision with the issue? That is the starting point. So you first start with the domestic laws, i.e. the Income Tax Act, the Transfer Pricing Regulation, and probably our practice notes, because for us, it has the force of law. So those are the domestic laws. That is the starting point. And where there are no specific provisions in our domestic laws, you can then make reference to the guidelines. And they are just guidelines as they are being described. And we'll look at which of them gives the best results. And in most cases, the UN guidelines, a lot of the time gets inspiration from the OECD, because the OECD, they are much bigger and they set the pace. So there are not much conflicts. We, from the Ghanaian perspective, we are saying that where there are no domestic provisions on an issue, you make reference to any of the guidelines, i.e. the OECD guidelines on transfer pricing and the UN practice manual on transfer pricing. So from the GRE point of view, there is no selection of which one is preferred to the other. But a lot of the time, so far as transfer pricing is concerned, a lot of them, there are alignments because the UN manual makes a lot of reference to the OECD guidelines. So we'll look at it and look at it a case-by-case basis and see which of them gives the right results. If there is any conflicts, that is what I can say in terms of that. Because our practice notes had made provision that where there are no specific provisions in our domestic laws, you may refer to those two guidelines, and they are just mere guidelines, as I want to put it. In terms of the data source, when you are looking at a transaction, either as a company, you are preparing your documentation to ensure that, or to confirm that the transaction is in accord with the arm's length principle, you go out and look for comparable transactions. There are different approaches that you can use. Depending on the nature of the transaction, you may not need to go into any database. So for example, you are dealing with a financial arrangement and there are information in Bank of Ghana website, reliable website or public available data, you may refer to it. The underlying principle is that the information that you are going to use or the comparable should give you the best results. Because information is most of the time not available or confidential in nature, there are databases that has been built by internationally recognized institutions, and then you subscribe to them. So in Ghana, for example, or the GRA, we have subscribed to one of the biggest database that most institutions are using. I'm aware institutions like PwC and I'll say the Big Four, and most good revenue authorities are using that. That is TP Catalyst, which used to be called Bureau Van Dyke database. We subscribe to TP Catalyst database. We also subscribe to a database called Royalty Range. And if you go in there, likely, if you are lucky, you may get comparable pricing, depending on the methods that you are using. So I think it depends on the nature of the transaction and which comparable data will give you the right results. So you mentioned in the case of water, now you are looking at a transaction involving water that is being supplied between persons in a control relationship. You go out to a reliable source of market, which most of the time need to be publicly available, or you should be able to provide it to the other party, or if it's a company that is trying to confirm that its supply of water to another party in a control relationship is in accord with the arm's length, the comparable that you are using, you should be able to tender it to the revenue authority to say that this is a similar transaction that has occurred and the pricing is the same thing. So we do not have specific preferences, but which one gives you the right results to prove that the transaction is determined fairly, that reflects the arm's length principle or a market price. Or if you were making a similar supply to a third party, you would have transferred it or sell it at the same price. So I could just maybe, if you have a follow-up question, in terms of the preference between OECD and UN, there are all guidelines that you can make reference to. So we, from the Revenue Authority, haven't selected which one should be preferred to the other. Which one will give the right results? And in selecting any of the 5 methods that has been mentioned by Kingsley, we looked at, and the OECD guidelines also make that emphasis. Select the method that gives the right results. And in Kingsley's description of the methods, I think that's one of the challenges. Maybe we'll come to that. In a taxpayer, in testing that your transaction is arm's length, you may have a cap that may give you the right resource, but it's been abandoned and go for another method. Maybe we'll look at that later. But generally, from the transfer pricing rules perspective, select the method that gives you the right resource that reflects the fairness of the arrangement between the control parties. So that is what I can say for your question. If you have a follow-up question, I can take it. Thank you.
Thank you very much, Moses. So let me just recap for the sake of our audience. What you've said is that, yes, you can look at either the OECD or the UN model, but make sure that it gives adequate guidance to the issue. But as far as the revenue is concerned, you will start with our laws and our regulations, and your practice notes and administrative guidelines are also laws to you. It has the effect, or as you call it, the force of law. So a taxpayer must also look at that in trying to determine what price is determined on an arm's length basis. Coming to the issue of compliance, and maybe Kingsley, I would come to you. Is there particular documents that taxpayers need to prepare? And even if they prepare those documents, should it be kept in their drawers? Should they be submitted to the GRA? By when should those documents be prepared? By when should they be submitted? And then Moses can help us deal with, what if we say we are tired? This is costing us too much money. We can't prepare the document. We will not even submit what you require us to submit. Are there any sanctions? What is it that taxpayers must do to make sure that they are compliant? So Kingsley, I will start with you, and then Moses will help us deal with the issue of compliance. Thank you.
Okay, thank you very much, Abeku. So as far as the transfer pricing regulation is concerned, with regards to compliance, 3 or 4 things that every taxpayer or business engaged in control, if you like, transaction has to bear in mind. First of all, as from November 2020 upwards, the law requires that persons engaged in control transactions must prepare and submit to the Revenue Authority 4 months on or before 4 months after the end of their financial or accounting year, the following: a transfer pricing return disclosing certain information such as the group the person belongs to, the organizational charts, details of the transactions that took place between that person and all persons in control relationship. And mind you, as I indicated earlier, going forward, especially from 2023, entities will no longer be looking at 50% by way of voting power. You need to be looking at 25. So that is changed completely. And even persons in management may have to be in view. So transactions happening between related parties will be disclosed in the document. The TP method will have to be disclosed. The TP method used in arriving at that price, and a few other information. The copies of the returns are available on GRA websites. So that's not a problem at all. So first requirement, compliance obligation, transfer pricing return must be filed on or before 4 months after the financial year has ended. Now, if for one reason or the other, such a taxpayer is unable to file within the 4 months, the law allows or permits that person to put in a formal request to the Revenue Authority for an extension to be granted. And if you convince the Revenue Authority, I know they are very open-minded about that, and they tend to respond to such requests. They will do so and grant you up to 60 days extension as far as transfer pricing return is concerned. Then the second compliance requirement or obligation under the transfer pricing regulation is preparation and filing of local file. But let me take it together. Preparation and filing of local and master files with the Revenue Authority. Again, these two documents must be filed on or before 4 months after the financial year end of such taxpayers. Now, before November 2020, the law that existed, LI 2188, simply called these two documents the transfer pricing documentation, which must be prepared contemporaneously. At the same time that you are engaging in the transaction, you need to have these documents ready. But in terms of filing with the Revenue Authority, you would only file it 4 months after the year end. And I must say that prior to November 2020, the law did not require taxpayers to file the transfer pricing documentation or the local file and master file. So if anybody has periods, how do you call it? Periods that cover 2012, 13, 14 to 19, you do not need to file the TP documentation. But for 2020 upwards, you have to file it. What goes into it? Basically, it's about talking about the company, the group the company belongs to, the business it does, its competitive position as far as the sector that it operates in, it's concerned, transactions that has taken place between related parties, the methods that have been used in pricing those related parties, benchmarks that are done or that have been done to reflect or support the price that those transactions were consummated. Then you would have some group information, the entire group information being kept or being recorded in the master file, including any pricing arrangements that the group benefits from. So that those ones will sit in the master file. The divisions, the strategic divisions of the business that the group runs, all these will go into the master file. But the local file, by its name generally, would cover largely issues or matters concerning the local company and those transactions that the local company engaged or consummated or executed with the other persons in control, that they are in control relationship. There is a final compliance obligation. So I've listed transfer pricing return, local file, master file. All these three must be filed on or before 4 months after the end of the accounting year or financial year. The fourth one is the country by country report. And again, by its name, it is really a summary of all the entities within the group and certain key information. But as far as maybe I should step back a bit. For filing transfer pricing return, once you engage in a transaction with a related party, you must file a transfer pricing return. For local file and master file, you do not need to prepare it and submit it. If, for instance, the transactional value, of the transaction concerned is not 200,000 or Ghana cedi equivalent of 200,000 USD. If it is not, you do not need, you are exempt from preparing it. But please note or take note that the Revenue Authority is empowered to actually aggregate 2 or more transactions if they feel that they are very similar and in substance reflect the same, if like, contract or service or supply of goods, but a taxpayer has deliberately, split it up in order to avoid or eliminate the burden of preparing that, TP documentation. So you don't need to file if the money or the amount involved is actually not more than Ghana cedi equivalent of 200,000. And in other cases, if you are providing low value add service, and the markup on it does not exceed 3%, there's also some waiver there. And then if you are also engaged in a payment which qualifies as a technology transfer agreement and is registered with the GIPC, and the payment for royalty, know-how, management, and technical service fee does not exceed 2% of the profit before tax, you may also have waiver, but ordinarily you will file a return. As for the return, once you are engaged in a control transaction, you will file a return. What you may not file what you may not prepare and file is the transfer pricing documentation or local file and master file if you don't go above these numbers I've talked about. And then finally, the country by country report, which is really prepared usually by the ultimate parent or some other entity that is designated to prepare it, and will be filed first of all in the country where that group company or that ultimate parent company is resident. And then this document will make its way to Ghana for Ghana to also file. But the due date for filing of country by country report is 12 months after the end of the relevant financial year. So there's difference in terms of the due date for country by country report, versus the requirement for filing return and local file and master file. I think that's all from me. But if I left anything out, Abeku, you can quickly remind me to just address that. Thanks.
No, that is fine, Kingsley. So what you've told us is that in terms of compliance requirements, if you do not engage, loosely said, with any related party, then you don't have any transfer pricing obligation. However, if you engage with a related party, at a minimum, you have to submit to the GRA a transfer pricing return, requiring you to provide GRA with certain kind of information not later than 4 months after the end of your financial year, unless an extension has been granted to you to file beyond that date. If you engage in transactions which exceed 200,000 with a related party, what you are saying is that you need to file a local and master file, or you need to prepare, a local and master file. Of course, best practice will require that you do this, but you have a choice not to do it if it doesn't exceed 200,000. And in certain instances, you have a country by country reporting that you also have to do, so long as you've engaged in a transfer pricing related activity. So on this note, I will move on to Moses to address the question. Moses, if I choose not to do any of this because I'm tired, what happens? And as a Ghanaian who owns or who has a conglomerate, am I even required to do these things? Moses, thank you.
Thank you, Abeku. Yeah, so in terms of either you are tired for whatever reason, I'm sure every serious businessman will never get tired for giving such basic information. So the law is very clear about that. And as Revenue Authority, we try to simplify things for our taxpayers who we view as our clients. So if you fail to comply with these requirements, there are penalty implications. And maybe I'll deal with the penalty implications first, and then I'll come to just highlight on how we have tried to simplify it or make it at least a bit flexible so that you never get tired in complying with these basic requirements. So one, if you fail to file the returns, our transfer pricing regulation has aligned the penalty or interest regime with the general regime as we have it in one law, the Revenue Administration Act 915. So if you fail to file the transfer pricing return, for example, you for the first day 500 Ghana cedi, as we are all aware, which is applicable to all tax returns, and then subsequently every day 10 cedi. That is just for the return. In terms of the documentation, the failure to maintain the documentation, for that matter, submitting same to us, the Revenue Administration has provided the penalty for that. And maybe you may want to make reference to Section 72, for example, where for failure to maintain documentation, you may be penalized, say 75% of the tax for that period, depending on the situation, or it may even be up to 200%, depending on the circumstance under 72 of the Revenue Administration. So Abeku, I can assure you that in just to make sure that our taxpayers comply with the requirements of the law in terms of the requirements to file what we call the transfer pricing return, which is just a disclosure document. Disclose that during the period, who were the related parties or persons in control relationship that we dealt with, what were the nature of the transactions. In terms of the total amount, you state the total amount, not the individual transactions. So if you bought goods from person in a control relationship, how much was it? What's the name? Those basic informations, disclose them, and then which method did you apply? And then the other three documentations, which the third one may not apply depending on the nature of the group or the volumes involved. The local file, which basically looks at the description of the nature of your business, what are the profit drivers, what are the challenges, competitors, and other basic informations, which are mainly domestic in nature. In the local file, you submit that one also within the 4 months, and you may be given extension, as Kingsley has said. And the extension that we can give is not exceeding 60 days. And you must submit the application for extension before the expiration of the four months. So if, for example, your year end is 31st December, not later than the last working day in April, you should submit your application. Say that we can grant the 2 months extension to you. And in most cases, the law requires that you must show good cause before the extension can be granted. But at least, as Kingsley has said, we try to be very reasonable and flexible in this area. So you can be granted 2 months extension, such a way that you'll be able to comply with the requirements of the law. And in terms of the documentation, which can be a bit elaborate and quite requiring some expertise, that is why we introduced in our new transfer pricing regulation, LI 2412, the issues around the safe harbor provisions, which we call simplified approach, just to reduce the level of burden on our taxpayers. We are saying that if the total value of the transaction is no more than 200,000, don't bother yourself going to prepare the local file or the master file. Then if, for example, the arrangement qualifies as a low value added intergroup services, and you comply with the fact that the amount that you are charging is cost, and the cost is genuine, and the markup is not more than 3%, obviously you can qualify under the low value added intergroup services safe harbor provision. So no need to prepare the local file and the master file and the others. And so we try to make that. And from last year, we made it that taxpayers can file anywhere you are. You go into our online filing portal and submit your returns. So you may not need to walk to our office and submit this manually. So we try to make it, the revenue is trying to see if we can deploy a mobile system or portal that you can even submit your returns on your phone if you have it on your phone. Just to make life a bit easy for our taxpayers and not make it that you become tired, as Abiku is saying. Abiku, at least every businessman wouldn't get tired to submit such a basic information. You get Kingsley & Co to put the documentation for you, and then you get it, because the penalties can be very huge if you look at it, and the image, your image can be dented for such non-compliance. So there are penalty implications for failure to comply with these compliance requirements. Yeah, thank you, Abiku.
Thank you very much, Moses. We'll try not to get tired. Let's explore the area of low-valued added items, transactions. How does the GRA determine that? Because from what Kingsley has said, one of the grounds for getting an exemption from doing the documentation is that what I got was a low-value adding service, for instance. So Moses, how does the GRA determine that, so that our audience can know whether there is really the requirement to put in place these documentations? For the return, we are clear, we all need to file. But we want to see whether there's an opportunity not to get tired from preparing documentation. Thank you.
Yeah, thank you, Abiku. Yeah, so the issue of low value added intergroup services is just, as people, it's a term of art, and the law has defined it, and we adopted it from Chapter 7 of the OECD guidelines, saying that we give certain intergroup services which are mostly administrative in nature. For example, if those support or those services are not the core business of the group, so you are an oil and gas company, to the extent that you are providing certain technical services which relates to the oil and gas or banking, it cannot fall within the low value added intergroup services. So one, the service should not be a core business of the group. Then you have certain other services which does not require the use of valuable intangible technology. You don't use technology to provide such support. Obviously, once you are using highly valuable IPs to provide those services, it does not qualify. Certain other things like insurance and the like, those things does not qualify for the low value added intergroup services. Mainly what I can just give on top of head are mostly this administrative support services that most groups will have. So most multinational will have, they say, a regional hub where all the accounting, the day-to-day running and other support are provided. Those administrative support may qualify within the what we describe as low value added intergroup services. They don't add much value to the business. They don't have a direct contribution to the product that is being sold. They are supportive in nature most of the time. That's why they are described as the low value added intergroup services, which we drive it from Chapter 7 of the OECD guidelines, just to lessen the burden that this is support that is given by the head office in the areas of, say, accounting, HR, internal audit, legal, and the rest, which as and when the local entity requires support, they reach out to them and it's provided to just to guide them. And one of the conditions is that the nature of the fee charge should be cost plus, and the markup being added should not be more than 3%. It could be less, but not more than 3%. Once you meet those conditions, you may enjoy the safe harbor provision of low value added intergroup services. You only need to file a transfer pricing return and no need to prepare a local file or a master file.
Thank you very much, Moses. And just before I move to Kingsley, so that I can catch some breath. So what you are saying is that some indicative factors you will check is whether it is just supportive, and whether the charge is cost plus, and the margin should not exceed 3%. So assuming a taxpayer wants a bit of certainty, can the taxpayer write to the revenue to request for a private ruling, or if there are a number of them, a class ruling? And would you consider a private ruling to have the same effect as an advance pricing agreement, which some countries do have? So as you may be very much aware, for some countries, if it's a transfer pricing related price request that they are making, they would call it advanced pricing agreements or arrangements. In Ghana, to get a bit of clarity on some of these things, should a taxpayer be doing a private ruling request or a class ruling request, depending on the situation? And would the transfer pricing or the GRA consider that to also have an effect of a pricing or an advanced pricing agreement? So this is the question I would ask you before I move on to Kingsley. Thank you.
Thank you, Abeku. Yeah, so in terms of advanced pricing agreements, in our regulation, we do not provide specific for that.
Okay.
However, if due to the nature of your arrangement, you are not able to fit into any of the 5 methods as provided in the regulation, you are permitted to write to the Commissioner General that this is the nature of your arrangement, and due to its nature, you are not able to apply any of the 5 methods, and that you intend to use a particular method that you want to recommend. The Commissioner General will look at it, and then once we are comfortable, we'll write to you and confirm that please go ahead, you can use this. And I can say that it assumes the character of an advanced pricing arrangement. So we don't have it in law, but based on the basis of the revenue administration, that is possible. And then the other part of your question are the issues or the areas like class rulings or private rulings. Yes, we are working with the revenue administration, and once a taxpayer or a group of taxpayers want clarity on a particular issue, they can write to the Commissioner General, and on the basis of the revenue administration, the Commissioner General will respond based on the requirements of the law, and then clarity can be brought. So if, for example, the UK Ghana Chamber of Commerce want clarity for its members on the area of low value adding intergroup services, that can be responded to by the Commissioner General. So that opportunity is available to taxpayers.
Thank you very much, Moses. And then Kingsley, let me come to you maybe for a very brief response, and then I'll pick up the questions that are coming in through the chat, the number of questions. And then if time permits, I would allow some to ask questions by voice as part of this interaction. Kingsley, you have been consulting across West Africa and also have experience in the southern part of our continent. As I did say from the beginning of this conversation, transfer pricing has been in our records, as far as I'm aware, since 2000. However, we started applying it a bit more in 2012, 2013, depending on how you want to do the count. We've also had thin capitalization in our books for a while. And unlike transfer pricing, our earliest encounter is that thin cap has always been dealt with or applied. And we've seen it move from a ratio of 2:1 to 3:1 in general. And as you are very much aware of, underlining thin capitalization provision is the whole issue of some relationship existing between the giver of the loan and the recipient, of course, if certain additional requirements are met. Kingsley, in your view, and probably as a proposal for policy consideration, do we still need thin cap as a special provision in our law? Or in your view, when we apply thin cap, yes, we understand it is a capital structure related question, as against some who say transfer pricing determines the price or the rate of tax. But putting together your experience, do you think it's about time we clarify in our law that when thin cap applies, transfer pricing should not apply? Or should we even do away totally with thin cap and then just focus on the arrangement and ask whether the loan and its price is at arm's length? What is your view on this, Kingsley?
Thank you, Abeku. So before I get to answer that question, let me just quickly say that as far as low value added service is concerned, all that Moses has said is true. But then there's also a provision in the law that empowers a taxpayer who thinks or believes that it has received low value added service to consider making an election in writing. So you make an election in writing to the Commissioner General. And then if you fit the bill, the Commissioner General obviously would agree. But if you don't fit it, I'm sure they will respond back to you and say, look, we've looked at the contract, we've looked at the services, the nature of the services. These are no low value added. And as a result, you are not qualified. So yes, by all means, you can do a ruling, but the remedy provided in the law is really an election in writing. Yeah. Okay. So that, now that that's out of the way, yeah. Look, I come to the thin capitalization issue. Yes, you're right. At the heart of thin capitalization is really that determination to ensure that shareholders don't use financial transactions or financial arrangements, right, to push down debts to levels that will, if I may loosely say, suffocate local enterprises or the borrowers to the extent that the tax base will be eroded. So when a borrower lends money from a related party, the borrower ordinarily will pay interest. And if the lender is actually not in Ghana, it's out there, it may invariably lend in a foreign currency. We're in a developing economy or country where the depreciation of our currency, we all know what happens, whether it goes north or south, right? Most of the times. So you would have a situation where you are not only dealing with even the interest expense that is being charged or will be charged, but then there's also exchange loss, whether realized or unrealized, that may hit the P&L of this entity, right? And the more the loans are to the borrower who is in Ghana, the higher the expense, whether foreign exchange loss or interest expense. And as a result, that can actually lead to profits being turned into losses, and so as far as transfer pricing, look, transfer pricing is there to make sure with financial transactions or loans and interest, is really make sure that a borrower is actually taking a loan that is needed, that it can afford, that it has needs for based on its, if like, plan. Some borrowers go for money that they truly need. Others may not necessarily need it. So you need to do things like debt capacity analysis to really come to the conclusion that this company is capable of receiving this money and will put that money to use. Then you move to whether the pricing, of the interest or the return on the money is right or wrong. Under our law, you need to consider the jurisdiction of both the lender and the borrower. You can't only consider the borrower's jurisdiction. Yes, we are in a jurisdiction that would normally have high interest, but where is the money coming from? Where did the lender also get the money from? All this analysis will culminate in one, whether the loan should have been advanced, two, whether the interest is priced right. Once it's priced right, if the entity, the borrower in Ghana, exists to make profits, and we have eliminated all the motivations of, if you like, mispricing, then the entire amount should be deducted or deductible. So I tend to gravitate towards, using transfer pricing to cure all financial transactions or arrangement issues as far as interest and like forex losses are concerned. I believe that school of thought or that position is very fair. It's very fair. But then, look, as you rightly said, we are aware that in some other jurisdiction, there is a blanket restriction on interest deductibility, regardless of whether the loan or the amount is coming from a related party. So if you look at thing capitalization, with that lens, that a company or a taxpayer should not borrow, and incur interest expense up and beyond a certain level of its income in a year, then that provision could make sense. But generally speaking, if we leave internal management, decision-making, management and direction of companies to these businesses, and we know or we trust that they are making decisions that would ultimately lead to maximization of profit and their earnings, right? Then they wouldn't go into any arrangement that will reduce their profits, hence tax revenue, right? And then if you then add the transfer pricing instrumentality of making sure that if the amount is not needed, if it is overpriced, or if the terms and conditions are such that they are unfavorable, you would adjust it by using comparable set of data. Then looking at the two schools of thought, you may just have to deal with issues around interest, foreign exchange losses, as far as shareholder loans are concerned, using transfer pricing, and then let it not apply, in any other case. And I know, Abeku, you've seen what the regulation did in the LI 2244 when it came to the definition of debt. It is somewhat silent. Yeah, it's somewhat silent. It's somewhat broader than what was contained in the Internal Revenue Act, which is repealed. And I know there's been some attempt, I think, from the Revenue Authority side to actually broaden, what we knew to be thinker, that we should be comparing only shareholder loans to the shareholders' equity when we are determining a 3-to-1. So I think it's about time that we move to where most countries are. I think most countries are now using transfer pricing to deal with interest and its related issues as long as it's coming from the shareholder. Yeah.
All right.
So that's all for me. Thank you very much.
So thank you very much. And I would, because it's a policy question and Moses also what my expectation would be that he would also make suggestions. I'll also let him give his view on the same question. But in doing that, Moses, I'm just going to restrict your time because I really want to pick some of the Q&A questions here and ask that, in your experience, does the revenue do secondary adjustments? And these are some of the questions I'm receiving. So to explain, usually your audit would go in and raise a liability from a TP audit. Do you go and check on the other side and tell company A that because I assess this company more to tax, please increase your costs and reduce your taxes? Do you do that? So Moses, help me respond to this, probably the next 2-3 minutes, and then we can pick up some of the chat questions. Thank you very much.
Thank you, Abeku. Yeah, so in terms of secondary adjustments, if it is not within our, purview, or we do not have to do that for you. If we are auditing company or taxpayer A, we look at your arrangement. Are they consistent with the arm's length principle as required by regulation? If yes, we say, voila, we allow you to go. But if there are reasons to do an adjustment, we do that. It's not up to you or the other party who, if based on that adjustment that the transfer pricing audit has done, you have reasons, I think it's up to you to then, because we mostly audit past years. So we cannot come and say that we want to do adjustment to your tax returns that you filed for those periods. So what I would ordinarily recommend is that it's up to the taxpayer to then write to the Commissioner General to seek for, probably a refiling of the returns, but we cannot do an automatic adjustment to even a taxpayer who is not within, we are not auditing. We ordinarily wouldn't know what transpired in that. So to answer your question straight, it's up to the taxpayer to then look at what has happened at the other side. What is the impact for me? Then you can look at that. I know that even under the guidelines, automatic adjustment is not that available in certain instances, even where it can arise. Those adjustments can give room for double taxation. Under the MAPs, those arrangements or discussions can be done, but dependent on the taxpayer, who then apply to the revenue to look at the impact of the corresponding adjustment. Yeah, so that's what I can say to that. Did you want?
Yes, so I said, do you also want to comment on the think cap?
The think cap, good. Just
linked to transfer pricing, yeah.
Yeah, good. Obviously, there is no conflict between the transfer pricing rules and think cap rules. As you know, think cap rule has been around not today, and they work hand in hand. In our audits, think cap provisions are specific in nature, and therefore, and the arm's length rule is general in nature. So usually what we do is that the fact that the think cap rule is specific, it overrides. So you first have to look at, does the think cap rule apply to this transaction, this financial arrangement? If yes, you looked at it and see. Otherwise, then you move to the arm's length implication of the transaction. In terms of if we should still have it in our books, I think that, if you look at the BEPS recommendations, the BEPS is still encouraging that countries that do not have think cap provisions may consider it, because there are good reasons behind think cap provisions. As they normally say, debt is cheaper than equity, and you are the investor. If you want to finance your subsidiary, why don't you also invest in equity? And if you want to invest, try to strike a balance. Don't starve them of funding in the form of equity and then invest in the form of capital, debt. Strike a balance. There are good reasons, there are pros and cons around it. Yes, there are only a few countries that may be walking away from it, but to my mind, most countries which do not have think cap provisions are rather going for think cap. Then you try to see how you can marry the two anti-avoidance provisions. Yes, from a business perspective, you may have good reasons, good concerns as to if we should apply only one side of it. But what we do is that we strike a balance to ensure that we don't overburden our taxpayers by engaging in double adjustment of the same transaction. Otherwise, they serve different purposes. As an investor, if you are investing, make sure that you strike a balance in how much you are putting into equity and how much you are putting into debt, such that you don't, your arrangement doesn't affect the tax base, such that the revenue authority that also, or the state that you are operating will not also lose so much. So it's a matter of striking a balance. But generally, I'm sure you are familiar with Kingsley. To BEPS recommendations is also pushing, and a lot of countries are looking at adopting think-up provisions. And as you said, some countries even have very strict regulations or approval regime for shareholder loans. So I think we depend on it, but we always try to strike a balance.
Thank you very much, Moses. It depends, but you will strike a balance. So as I did prompt our audience earlier, I'm going to run through the Q&A questions. The ones that I can attempt a response based on what Kingsley and Moses have said so far, I would. The ones that I can, I'll pass it to them for a yes, no answer or a single sentence answer. Audience, be minded that their response does not constitute professional advice. I would encourage you to seek professional advice if you need one, because as I said, I'm going to put them under pressure to respond to these questions. So it does not constitute professional advice, neither does it represent the views of their firms or the revenue authority. So the first question I have here is on anonymous attendee. The question isn't too clear to me. It says, what is the effect of taxation if the group AC is located, is funded? Is not clear, so I would move on. The second question is, does TP still apply to wholly local owned companies within the same group? I think Moses has responded by saying yes. If you're a Ghanaian having a conglomerate of businesses, it applies to you. So it is not only to foreign businesses. The third one, which I would probably go to Kingsley for just a one-line response, is please do DTT override the internal TP regulations? In other words, does double taxation treaties override internal transfer pricing regulations?
Well, I would say that it depends, but generally no. If you look at the double tax treaty provisions, each of the ones that Ghana has signed, they're receiving a requirement around transfer pricing in terms of transactions with associates, right? Exactly, it says that those transactions must be done at arm's length. So within the double tax treaty, there's a recognition that you need to trade at arm's length. And
all right.
So, I mean, from that perspective,
I'm going to be running, so it depends.
Fast. Okay, thank you.
Please, LY, contact the revenue or the advisor for guidance on that. So the next question from Emmanuel has been addressed in a way. It says, since the revenue's position on the preference of a UN or OECD model is unknown, how can taxpayers comply at the price setting stage, as well as price testing stage? So various options have come up. Moses, you can always correct me. You can write to the revenue for confirmation, say in a private or class ruling. The next one is, who has to file TP return? So Moses, I come to you. Who has to file a TP return? Is it a parent company, the associate, or the subsidiary? For a one-line response.
Okay, the person who is required to file transfer pricing return is the entity which is in Ghana. They are required to file all the 4 type of documentation with us. That is the transfer pricing returns and the other 3 documents. So
thank you very much,
written in Ghana is supposed.
So the next question, I would have gone to Kingsley, but it comes specifically. The person asks, Joel says, I should ask you specifically. Is Ghana planning to join the OECD Multilateral Authority Agreement platform for the purposes of CBCR data sharing?
Abeku, yes, the progress, we are at advanced stage to get that done. that discussion has advanced. The Ministry of Finance is dealing with that.
Okay. So let me go to Kingsley. Festus is asking, does the law apply to country by country file if the local law does not apply to countries within the group? Does the law apply to country by country file if the local laws does not apply to countries within the group? I hope you get a question. So if in the country of, say, the parents, they do not have local laws that requires country to country filing, country by country filing, sorry, does it still apply? And if yes, what are the reasons why it should apply?
Well, you know, as I said, tax is jurisdictional. Every country has the right to make laws. So if the country where the group is tax resident or is headquartered, how do you call it, doesn't have the requirement to prepare CBCR, but Ghana has done that to the extent that in Ghana, the entity operating here actually meets the threshold. So the threshold is 2.9 billion, right? Ghana, see the group's consolidated revenue the year before the relevant year should be 2.9 billion Ghana cedi. If you meet that, you have to prepare. And so then by extension, the group would have to assist you to prepare it.
All right. So Kingsley, sorry, I need to move. Just a minute. I need to move. Yeah. Thank you. Moses, and I know it sounds as if I'm doing an NSMQ here, but yes, that's what we need to do to be within time. Moses, does the 200K apply to single type of TP transaction, or would the revenue consolidate all TP types of transaction when it comes to the 200,000 that we said you could get an exemption from documentation for?
The 200,000 is applicable to a specific type of transaction.
All right.
So if, for example, it's for service of, say, IT in nature, you consolidate it if it's broken.
Okay. But the GRA may consolidate it.
All right. Thank you. So, sorry, Prince. Today we said we're not going to talk about TP and indirect taxes. We'll struggle with time if we're going to do that. So Prince's question was, how does the revenue address inconsistencies arising from arm's length and custom values? So that would probably be dealt with if the chamber considers appropriate for us to consider it. But I do agree the laws must speak to each other. But sorry, Prince, we are unable to deal with indirect tax consequences of TP for today. Richard, if both the parents are based in Ghana, should they both file? I think Moses has responded that yes, it applies to entities in Ghana. So I would expect that both parents and associates should both file. Yes, Moses, go ahead.
Okay, so I just wanted to add that in the case of the local file and the TP returns, both will have to file. But when it comes to master and CBCR, only one entity will submit.
Thank you very much. Thank you very much. Thank you very much, Moses. I just got a question trip in, Moses. Let me come to you for just a minute. It says, please, what are the government plans for instituting mutual agreement procedures, or what others call MAP rules, to help relieve double taxation from TP adjustments? Did you get a question? So what are our plans in instituting MAP rules, because they're already in our treaties, to help relieve or help provide relief of credit for double taxation that arises purposely from TP adjustments? So if country A adjusts, what are we going to do in Ghana to relieve the taxpayers from that?
Yeah.
What are the government's plans? Yes. Go ahead, Moses.
Yeah. Yes, I think I mentioned that earlier. Under the MAPs, we do have such engagements as and when they arise, especially where there's a GTA. We're able to have such engagements.
All right. Yeah. Great. Lastly, Moses, to you, speaking of BEPS, what is Ghana's status on the MLI, the multilateral instrument, which are to help provide updates to the DTTs for BEPS across the board? So as you are very much aware, we've been on all these projects from 2013, with later the OECD extending a hand to various non-OECD and non-G20 countries. So the one asking the question is asking that if you look at even the recent OECD model tax treaties or model tax convention, they've been updated to reflect some of these. So the person is asking, speaking of the BEPS, what is our status with respect to the MLI, which are to help provide updates for DTTs for best practices? What is the position of Ghana on this matter? Yes, I know we are not part of the inclusive framework, but is there anything that you wish to say in that regard before I go to the last question?
Yeah, okay, I'll be quick. So you would have seen that our new regulation, LI 2412, adopted a lot of some of the BEPS recommendations. So
okay,
we do not sit in isolation, even though not a member of OECD or the inclusive framework, but as and a country, a sovereign state, as of course, we try to also reflect what is happening globally. So some of these things are under discussions, and the policy units, we recommend to the policy unit, and they have to take it to the next step. So some of these things are being recommended and they are being looked at. So
all right,
I can assure you that we don't.
Moses, some speed race for you, which is the last question you probably would have seen come through right now. It says, in the case of intangible assets, what would be the posture of the GRA if there are main sources of TP disputes? So in the case of intangible assets, what would be the posture of the GRA if this is actually the main source of TP disputes?
I think TP disputes can arise from any control transaction, either intangible or any of the others. And our posture is that comply with the arm's length principle. And then we look for the comparables as if they are available. And then we apply the rules as stipulated in our regulation, as well as the guidelines that exist internationally, to ensure that the transaction reflects a fair price and nothing more. That is our posture.
All right. So thank you very much. Moses, in 30 seconds, can you give us your concluding remarks as we try to draw the curtains down on today's conversation?
Okay, thank you, Abeku, and our audience. I think our recommendation would be to our clients is that they should try as much as possible to comply with the law in terms of filing the required returns, maintaining contemporaneous documentation as required. I will say that documentation has been one of our biggest challenge. Mostly you wait when you come to do an audit. That's when they are now running to then put these documents together. So we are recommending that taxpayers should ensure that they maintain contemporaneous documentation, such that when we come for an audit, we do not have a lot of issues. We can approach Kingsley and his firm. They can do that for you. And when there's an audit, we do not have so many issues, and penalties can be contemplated. No, just comply with the law. Thank you, Abeku.
Thank you very much, Moses. So I hear Moses saying that the revenue does not just take interest in applying sanctions for non-compliance. So please speak to your advisors, get guidance, and meet the provisions of the law. Kingsley, final comment in 30 seconds.
Thank you very much, Abeku, and our audience for having us. Indeed, as I said in my initial comments, transfer pricing is not a tax. It is just a means to make sure that the right incomes and expenses are recorded in our books and in the country using appropriate methods, and where inappropriate, we can always seek approval from the Revenue Authority for such approvals to be given. And consultants like us, and I'm sure a few that have joined here, are available to help, ensure or shore up the compliance levels of companies in Ghana. So thanks, very much for having me.
Okay, so thank you very much, Kingsley. Thank you very much, Moses. Thank you to our distinguished audience. And just to end, we wish to remind you that there are so many documents available to assist you to comply. And also, we wish to also remind you that the chamber is always there to support you in your advocacy and your networking needs and requirements. So please follow the chamber on its various social media handles. You can follow the chamber on its Facebook handle, its Twitter accounts, its Instagram accounts, and its various YouTube channels. And if you wish to become a member of the chamber, please contact the chamber by calling 025-796-2287. And on your screen, there are a number of documents there which you can scan or you can Google and pick them right on the various websites. My name remains unchanged as Abeku Jan Kwanzaa, and as long as you wish to comply with the laws of Ghana, I would remain your cheerleader. Thank you very much, and we look forward to engaging you in future sessions. Thank you, and bye-bye.